So good morning. My name is Richard Seline. I've had an opportunity, obviously, to spend a lot of time with many of y'all in the past. Um, and thank you for those who are able to join us live as I described to Scott, Eric, and Evan. Um, those who join us, Scott, are like the live studio audience because others tend now to register or indicate they'd like to participate, but really just want to see the recording at their at their pace. Um, we've got a lot to cover as we normally do, and then a little bit of a wrap up for what we've been working on this year and what's about ready to launch for 2026. Um, we've got a great group of folks, Scott, Evan, and Eric, that will join us, and we hope that they will, when we get to a certain period of the fireside, we'll get a chance to have them ask some questions or indicate some insights as well. So I'm looking at and monitoring the chat so that folks can give us some sense if they've got some thoughts. Um, the three of y'all need not, be reminded, but we show a couple of these as a lead in of why this, why now, what we're doing, and why we're doing this. And it really starts with the reality that this is not a periodic or episodic series of disasters, but this is literally one disaster upon another. Um, Various types, everything from wildfires to floods to hailstorms to tornadoes. It's every part of the country being hit, and the consequences, as the three of y'all have taught me and mentored me, are continuing to mount, whether it's insurance, reinsurance, mortgage, financing, taxes, whatever it is, operations. The consequences, Eric, as you know, have a economic consequence. Evan, as you know, have an engineering and operational consequence, and as Scott will talk about, the opportunity to affect finance and investment. So we identify these six issues, these six problems. Scott, unfortunately, I have been termed the Vin Diesel of doom when I show what I'm about ready to show, but we've looked at all six of these because we have felt that these are what we call the enlightened stakeholders that need to be at the table in some form of their interest in us addressing pre-disaster risk mitigation. That is our focus. It's not that we're not interested in the immediate response and recovery and rebuild, but we know that there is a cost benefit to lean in to actually start addressing these issues before the next set of storms. And the consequences of not leaning in are increasingly higher. Um, our board has now expanded. We've recently, as I mentioned, added David Marstead, who is, a literally leading mind, leading executive from the state, local, federal level, but also from the private sector in the insurance industry. So we are welcome, to have David on board. I think David has joined us. We've also recently added Erin D., who comes to us from the mortgage industry. She's currently the president of the Texas Mortgage Bankers Association, COO of a national, I think they're in 38 states, Evan, on the mortgage lending industry. And Aaron is a very present individual on this issue of resilience in the mortgage industry. So we've got a great team that we've put together as our national advisory board and leadership, which then in turn helps us bring together what we now describe, Scott, as a think tank and a do tank. Future Proofing America as a 501c3 operates where we're bringing the best minds, two of which are on this call, Scott, in addition to your brilliance. But we brought great people together who have been quietly over the past 18 months tying down how we should approach this pivot in the nation's risk exposure. And so you see who we have at the table that's been giving us lots of insight, but also very practical ways to deliver a new approach. And that is what we call the Future Proofing America framework, which goes from data all the way over to implementation and projects. As a lead-in, Scott, to where Fitch has gotten to and where y'all are going, there are no indicators that are in a positive direction. That's the sad part about this. All right, lost claims, including uninsured, are going up. This is kind of a normalized approach to looking at the data. We have not done our deep dive in all of this using our resilience data exchange. You see how the losses are mounting in residential, commercial, and public sector. You see how the losses are mounting at the federal, state, and municipal level. So the forecasts are not good. All right. Going a little bit deeper, when we started looking at this rising insurance loss and protection gap, which continues to be, about all of this, all right, is one of the challenges is this insurance gap that's occurred across the nation where rates are going up, markets are being reduced. But what we also have is a corresponding amount of defaults in the mortgage, both residential and commercial. If you can't get insurance, you can't get a mortgage. But what's worse is when you've had a terrible event, Evan, as you well know, whether it's a wildfire out in your part of the world or an earthquake, and the damage is just too significant, people tend to do what they have to do, and that is they just walk away from the asset. The overriding challenge that we've started noticing more, and it's because of our relationship with CoreLogic, now known as Cotality, is this asset devaluation, Scott, which is really changing the underpinning of the tax base in a lot of communities. So not just for elected and appointed officials, but also for the large scale portfolio asset managers like Blackstone, BlackRock, Carlyle, and others, right? One of the things that we're going to talk about, Scott and Evan and Eric know this as well, is there's all of the tools, technologies, kind of products, services, even capital out there, but no real estate developer, real estate investor is going to do any of this pre-disaster investment, which could run 20 to 30% more than the baseline if there isn't a way to offset first cost hurdles. At the same time, elected and appointed officials are tired of going back to the tax base to ask for more dollars to do the recovery and rebuild. And interesting, Scott, y'all raised this in some of your analytics at Fitch, is not every event is a presidential declaration level, which means a lot of these events are falling on state and local governments to pick up the cost for the constant repair and recovery. And then the one that really is kind of the glaring, blinking light, Eric, is the reality that there is a massive shift at the federal level of the role of the federal government in its roles, responsibility, and resources. There's a massive shift back to state and localities. So what states, counties, cities could rely on in the past for a certain amount of federal funds, including funding of this pre-disaster mitigation, is now clearly uncertain. All right. So we formed the Future Proofing America Collaborative to address the 6 issues. All right. One of those is what we're going to talk about today. And that is, how do you take a look at determining what you can do to monitor and increase the performance of assets, whether they're retrofit or new construction, that if you have a higher value for resilience, a higher value of risk mitigation, can it attract the capital the right way? And obviously, ratings play a role. Scott, last but not least, is we believe capital is no longer the issue, Evan. It really isn't. There is a lot of capital. If you open the aperture wider to where the capital sources are and how you can bring different forms of capital to the table, including tax credits and real estate entitlements or incentives of some kind. So there's a lot of capital to be organized. It's just very fragmented. Trying to determine how to unlock that capital. We believe that 2026 is a year, Scott, where this capital is going to start moving more towards this pre-disaster mitigation risk exposure. So, Scott, what we looked at based on spending some time with you and your team a year ago, Scott, in New York, was the role of credit ratings and resilience. And you all can read faster than I can talk, but we believe that there are these three kind of unique opportunities where ratings have an impact on public-private partnerships, the way of organizing capital. The ratings can play an encouragement or inspiration around reducing risk exposure. And then most importantly, how can we move capital ahead of the curve, ahead of the next disaster? So, Scott, I know that's a lot, but what this signals is that one of the last pieces in our puzzle, mortgage was the second to the last. We've been working with the mortgage industry and mortgage sector, but really the last part of this is to see how ratings begin to influence and impact. And so, Scott, it's great to have you join us. You and I have known each other for way, way too long in our prior lives with Arthur Andersen, but you have been wildly successful, Scott, in doing what you've done. And it really is, both an honor and just a great joy to see your success. Today, you come to us as the head of the global infrastructure and public finance part of Fitch Ratings. And so I know that's not the greatest of introductions. I know I didn't mention Cornell University enough, but I'm going to turn this over to you to walk us through a couple of things, but give us a little bit more background on yourself, and then we'll just jump into this.
Sure. Thanks, Richard. Great to be here. For those who don't know, Richard was my first manager ever when I started Arthur Andersen way too long ago. So it's a pleasure to be here.
I think we both had hair. I think we both had hair.
I think we did. We did. But a great opportunity to be here for a particular topic that I'm quite passionate about, and that is as I head up the global infrastructure group at Fitch. One of the things that we look at, and I think that's really what I'm here today to talk about, is the impact of climate risk and resiliency on those assets that we're assigning ratings to. Just background on the team itself, we have 80 plus analysts globally that are looking at infrastructure projects, and that runs the gamut in terms of the asset types from your energy project finance, whether that's wind and solar renewables or LNG, to traditional transportation, airports, seaports, toll roads, as well as one-off entities, whether those are stadium project financings or social infrastructure that are done as a P3, a public-private partnership. That really makes up our portfolio. And increasingly, as the world around us is changing and shifting, we wanted to make sure that we are consistently applying the risks that are out there to each of those individual credits that we rate on behalf of investors. And so what we've launched this year more recently is adding into our criteria. So the way a rating agency is set up, we have a methodology or a criteria of how we go about assigning a rating on behalf of investors. So an issuer comes in, looks for a rating. We have a criteria for how we rate it, whether that's in the infrastructure space, or that might be in other areas like public finance or structured finance, et cetera. We have a criteria. So in our infrastructure criteria this year, we added what we have is climate risk resiliency scores as part of that. And what we're doing is it's really a framework so that on a global basis, we're incorporating and identifying those credits that are the most susceptible to climate risk, whether that's wind or hail or flood, whatever the feature is. We're going out and identifying as a filter, if you will, for our analysts as we review the credits, whether they're new into the market, they're coming for a rating for the first time, or they're part of a monitored portfolio. And that was a big development for us this year.
Scott, can I ask a real quick question? I told you I was going to probably do this,
Sure.
but what you're about ready to cover is primarily the climate vulnerability score, correct?
Yes.
But the reality is that within the Fitch toolkit, you all come at this from several different directions. I may not be saying that correct, but this idea that y'all are really focusing on adaptation, finance, and other pieces. Am I correct that what we're going to hear about is one, obviously, as y'all define it as a core metric, but there's some other tools in the toolkit that you all bring to the table. Am I saying that right?
Within the larger Fitch, yes. And so
Yep.
I'm responsible for the infrastructure project finance group. Then
Right.
we have other sectors, other areas that are looking at it as it relates to those credits that they're monitoring. And then there's Fitch Solutions, which has a whole climate risk and entity of it. But I'm looking at it from a purely from a credit standpoint. And one of the things that why I am so passionate about it in the infrastructure space is what we rate are hard physical assets. A lot of times they are very site specific, and they need to be able to perform. And when I say perform, be able to generate revenue and generate cash flow to be able to meet the debt service obligations that are issued off of those. And in order to do that, you have to be up and running in a state of good repair. And so as climate risk changes and shifts and the exposure increases, it's a very important variable or very important risk to take into that calculation, because we're in my space, we're talking about hard physical assets.
Right, right. And the reason why, I'm sorry for interrupting your flow, but I think it's important that you all are coming at this from residential, commercial, and large scale public infrastructure, which all fit into this perspective of that it really is not a risk profile for us is looking at a whole community. This discussion is really looking at, like you said, large scale infrastructure, which is some of the most underpinning pieces of the economic engines that have to be strengthened and fortified. So, Scott, sorry, I didn't mean to take you off your track, but I just wanted to make sure people knew there is this toolkit, and this is one of the several toolkits.
Sure. So as Richard's got on the screen, when you think about a rating, what do? We work on behalf of the investors to evaluate what their risk is. They're investing typically in bonds. They're buying bonds issued by an infrastructure project financing issuer. We're evaluating that. One of the key things we're doing is we're looking at cash flows. So we're forecasting out a lot of infrastructure. The debt is long dated. So you're talking about debt that's amortizing over the life of the asset. You're talking about going out 20 or 30 years. So increasingly in my role as a global head of infrastructure, I'm increasingly traveling around the world, meeting with investors, meeting with issuers. And the topic of climate risk and infrastructure resiliency is coming up globally at this point, because as investors are taking on risks for 20 or 30 years, they want to understand as the world around them shifts and events happen more frequently or with more tenacity, they want to understand how is the asset that they're investing in, how is that going to be impacted, and what does that mean for them. considerably. And one of the things that I think has shifted a lot, I know it's shifted in my thinking when it comes to infrastructure and project finances. And there was for a long time, there was a heavy reliance on the insurance industry, that the insurance industry, if there was an event, the insurance industry would be there to, to pay for it, whether that's in the form of the rebuild or business interruption. What we're increasingly seeing globally, not to pick on any individual markets, is that the cost of insurance is increasing for those assets in the infrastructure space. So the cost is going, and then you're getting various carve outs in terms of what's insured and what's uninsurable in those space. So that even puts more emphasis on why we are out there developing what we are in terms of the framework, in terms of being able to highlight the risk and include that into our analysis as part of our rating.
Scott, let me play off of something that you just said. As you and I know you've got a lot more to cover, but this is good because I think this is what we wanted to do, was be able to have a little bit more of a dialogue. Outside of the global need, and especially in the United States, the need to bring our infrastructure back up to what it should be, meaning we've gotten terrible grades from from transportation to, the federal agencies all the way over to, the engineering world and all. So we've got a deficit in bringing our infrastructure to current levels and beyond. But at the same time, Scott, are you seeing some of the infrastructure discussions to say we also need to now incorporate hardening the infrastructure, meaning not just doing what we normally have done based on historical? We're going to build this bridge. We're going to build something the same way. We're just going to get it to, current operational standard. Are you seeing a little bit of that pivot and shift occur?
Sure. It's very much situation dependent, but the idea behind it, as you're going out and building a new infrastructure asset, it's out there to last for decades, is to be able to incorporate what's happening in the world in terms of climate risk, in terms of being able to build it to withstand whether it's the frequency of the storms coming in terms of the named storms and the winds or the flooding that'll happen, but be able to withstand that is part of the analysis. And a lot of times that's a lot of the reason for the project, where we've seen, globally, probably taking one of the simplest examples would be a bridge. Replacing old bridges is, from a safety standpoint in terms of the condition of the existing bridge, but then also being able to take that as part of the replacement, take it and be able to withstand it, to have a longer useful life as part of that piece of it. So that's a lot of work.
So that useful life now is incorporating increasingly. I'm not trying to lead the witness. This really is a question. The useful life used to be basically how many cars, how many trucks, what's coming across, the tonnage, all those kinds of things, maybe certain conditions. But you're saying now increasingly you're observing that these factors related to disaster consequences are also feeding into the useful life.
Yes. Yep. That's exactly correct. I'm a transportation analyst at heart, and that's increasingly so that's why I always revert back to bridge examples and toll road examples, but you see it in other sectors as well, whether that's LNG facilities that are being able to withstand climate risks that's happening in those areas, and being able to develop a resiliency and infrastructure resiliency is a big part of what, that's part of the analysis. Because when we're looking at it from a credit standpoint, you can only generate the cash flows if the asset is up and operational and performing to a set standard. So as part of the analysis, you want to be able to understand, what does this thing look like 5 years, 10 years, 20 years from now, while you still got debt outstanding.
All right, so let me talk about, and I know Evan and Eric, y'all just keep on taking some mental notes, because we're going to, bring them into the conversation in a little bit, Scott. But let's talk about box number 2 and I mean, box number 3 and 4 up here. Okay. And I apologize. It looks a lot blurrier than it looked when I was putting this together. But let's talk about box 3 and 4 here. Um, One is the asset class, right? The use of the asset class, the functionality of the asset class. But increasingly, it's also where the asset is residing, the geography, the persistency of. And so one of the things that you've talked about in the past is, wildfires, floods, these kind of priority areas that y'all have built into, different perils, right? So in each case, when you are putting together the rating, go back to the larger part of the framework, Scott, the geography, the top type of persistent perils, the is also the what I would call the intensity factor, the intensification factor, which says that we're really going from like what Hurricane Michael was, a tropical storm at 3 o'clock on a Tuesday, and 24 hours later, it was a hurricane category 3. How do those things, Scott, fit into this?
Sure. So that's the initial part. Remember at the beginning where I said I talked about it as being a screener. So the
Yeah,
first part of the screener is getting at that, identifying where it is geographically. So is
right.
the asset in an area that's prone to the storms or prone to the high winds or to the wildfires, et cetera. So identifying that and then looking at, well, what are the mitigants? So okay, we know the thing with infrastructure, you can't pick up and move it to a different geographical location. You're where you are. So then the other piece of the equation is, well, what are the mitigants? Is it the design standard that there's proactive building here that makes this more resilient, more resistant to the exposed risk, or are there structural features inherent within the deal that help protect it? Insurance would be something that you could see as a potential mitigant if the policy is in place. And can withstand it, but it's also something you have to continue to monitor. Or are there other features in the structure, be that cash sweeps or something that protects the bondholders to the extent that they're exposed? There'll be some examples. I don't want to get into specific names where we've looked at assets that might be in a geographical area that's exposed over the longer term to something like flooding or storm risk. And we've said, as sea levels rise, that might be the type of asset that we could see play out in the nearer term, but it's hard for us to come up with an investment grade rating over a 30-year period, given the geographical location. So it's very specific, not only to the site, but also to the structure in place, depending upon what the mitigants might be in terms of the ability to assign a rating over the long term. So
You just raised something I don't think I've ever asked you about. All right. Does Fitch, Moody's, S&P, or your competitors, do y'all ever look at a project and go, we can't rate this?
So it would be something where it could be hard to say that it wouldn't necessarily be rated as much as given the risk might limit where we could ultimately rate it at a given level.
At an
Uh,
investment grade level, right?
yes, that it might be something where we could say, with this type of exposure, unmitigated, you could see it potentially being capped at investment grade for a shorter duration versus the longer term, given the exposure of the
Right.
asset. So it wouldn't necessarily be something that wouldn't be rateable. It just would be potentially at a lower rating.
Well, look, one of the things I always think that um, all of us are very knowledgeable in lots of things, but sometimes not as deep as we would like to be. Sometimes folks think that you guys at Fitch go into a room, light candles, turn music up real high, and pull a Ouija board out. I'm slightly saying that in lots of tongue in cheek, but the ability, without getting into proprietary or piercing the veil, which you and I've always discussed, I will never do, and you guys won't let us do for all the right reasons. But Scott, what that begins to tell me, and I pulled this up as again, part of the document that you all have made public is, how you look at these risk factors and the attributes to it. What it really starts saying to me is that a rating really will influence the cost of capital, will influence the like you said, the design and structural features. But one of the other impacts, all right, is the role of attracting insurance and reinsurance, especially reinsurance. So as you've traveled a little bit, Scott, and looked at y'all's framework, right? These different calculations under the framework and how, where are your sense of where the reinsurance sector is going?
Uh, that is difficult for me to necessarily say. I'm not having direct dialogue with them. I do know that there are certain areas where, from a project standpoint, from projects that we're rating, we are consistently seeing premiums going up, and
Right,
that impacts the financial metrics.
right,
That's all spelled out in our criteria in terms of
right.
coverage ratios and leverage. That's where we're seeing the largest impact as it relates to insurance itself. It's that, and then the premiums, as well as just the ability to be able to get the coverage.
And again, I think this is something that Evan and Eric and others we've discussed is, insurance, reinsurance tends to be rated on an annual basis against a project that could be 20, 30 years on the financing, right?
Well, and that's exactly so. When part of being a rating agency, so when we assign a rating to a project, let's call it energy project financing. It's signed up front as the project is built and constructed, but then we're reviewing it on an annual basis. So part of what we've added to our criteria in this framework for climate risk is the essentially the filter. So this flags to the analyst when there is additional um, level of analysis that's needed. And that additional level of analysis, it could be something where when we looked at it initially, that there was insurance available to help mitigate some of these risks. So that would obviously be something, as we're reviewing it on a regular basis as we maintain that rating, that we'll all have to go back to and look at how that's evolved and how the project itself is protected from those risks to the extent mitigants exist.
So y'all are really doing a constant tweaking in some regards.
Well, yes. So it would be everything is reviewed on an annual
Right.
basis, if not sooner. To the extent that if events transpire that need to be done sooner, then obviously it would be. But at a minimum, it's reviewed on an annual basis. And the screener that we've added to our master criteria for infra and project finance embeds that as part of the analyst's analysis. The other piece that we talk about that would inform, and it was on one of your earlier slides that you had up, Richard. A big part of this is we look at cash flows. So in project finance, it's all about cash flows because we're talking about 20, 30 years out. We have what's called a base case and a rating case. Base is the expectation of how we expect the asset to perform financially. Rating case is in a normal course of an economic cycle. How is the asset expected to perform and maintain its rating? So when we think about climate risk and infrastructure resiliency, as that evolves and risks become more heightened, you would expect to see changes to the base and rating case potentially as a result of that.
That means to me, what I just heard was um, as an asset owner, as an asset manager, I I get a couple of bites at the apple, so to speak, Scott, that I could come back and look at my asset and do some retrofit to harden it even further than the original project looked at. And if I do that kind of strengthening and hardening that was not on the original plan and the original, cutting the ribbon for the asset, but say 5 years later, Scott, I come in and I do whatever, Evan on, earthquake or something on wildfire, whatever it is. If I do that retrofit, how does the rating on an annualized basis of the analysts come back and take a look at that? I mean, obviously, I'm maybe stating the obvious, but that would have an impact on the rating, correct?
Well, it really would depend on the situation. In that, you would be talking about an asset that presumably, in your hypothetical example, Richard, would be an asset that there was something triggered, that it was an exposed risk,
Right.
and therefore it was a level of stress that was built into our analysis.
Uh-huh.
And if that was to suddenly be a retrofit and deem that it's not exposed, or that risk is more mitigated, potentially could have an impact. But it really would depend on the situation and the facts and
Right.
circumstances.
Yeah, and please know, I am not, and you and I have always agreed on this. This is not whatever you're saying. I will always put the legal operational asterisk at the bottom of every one of these conversations, Scott. This is by no means Fitch committing to do X, Y, and Z.
Yeah,
I'm
just
looking at,
talking. Yeah,
yeah,
this is just about how our approach and what we.
yeah,
One of the things that maybe I didn't mention at the beginning, when we think about the framework
right,
that we've added to the criteria, is this is the beginning point. So we've added it as part of our criteria. No ratings changed as a result of adding it to the criteria. But it's, if you think about 2025 as a starting point, and
right,
as topics in the world around changes and evolves, this is kind of the benchmark, and we'll see how um, things change and as risks become more heightened, and if they are or are not mitigated, that would certainly have an impact on the credit strength. But it's the beginning of a journey, and one of the key things to point out here is it's just so heightened specifically in the infrastructure project finance space, and different than other parts of finance, because it's related to hard physical assets that are very exposed, um, depending upon the geographical location.
right. All right. So, Scott, I'm going to pause there. And because we'll come back to a few things when we do our wrap up. I know I'm watching the clock, but and also if there's questions, people want to have follow-on questions, Scott, I'll make sure that people, if it's okay, have your email address for some follow-on. Let me ask Eric, Bill, and Evan Reis to jump in here. I'll let you two guys do better introductions than I could ever do, but I got a chance to meet Eric. Um, what is it now? 7 years ago in Florida, in a very unusual scenario, Scott, that I got invited to a meeting with a group of folks that were looking very uh, uh, differently at South Florida and Miami, and really trying to put some economics behind the consequences of doing something versus not doing something. And so Eric's been a part of our brain trust, um, and he can explain a little bit more. And then I got a chance to meet Evan, what now 3 years ago, in the work that Evan's been doing under the Resilience Council. Both of them have been great mentors and great resources to this. So just take a minute. Eric, you start. Evan, you follow, of just a minute of introduction, but give us some thoughts on what you're hearing and where you see, and as Scott just said, this is the start of a journey. This is not an end point. This is just the beginning steps. But give us your thoughts of what you've heard, but also what you're observing out in the marketplace. So Eric, go first. Evan, if you'll go second.
Happy to jump in. Hey, everyone. Great to be here, part of the panel. Scott, thanks so much for walking us through that. So, yeah, I'm an economist in the infrastructure and real estate space. So, Autocase is a bunch of economists, data scientists, and software engineers. So, we support mostly the infrastructure owners market. We work mostly for public organizations that own, operate, design, and invest in infrastructure that makes the world go round. Often our team of economists are partners with the engineers, the architects, the scientists, and planners that help to design, shape, and plot out that infrastructure. And so, hearing about the rating process incorporating climate hazards, vulnerabilities into credit analysis and supporting the fundamentals, let's call it incorporating climate risk as a capital allocation determinant is really exciting for me as an economist. And typically I'm working in a slightly earlier stage, let's call it, and I'm going to connect it to Richard's depiction of our first meeting as well, where we're supporting the design and planning of these major infrastructure projects. So Scott mentioned transportation and his history in the transportation space. So we support major transit investments, transportation, multimodal of all sorts, climate adaptation, hazard mitigation, water, wastewater, you name it. We're part of it, and typically playing that role of supporting the comparison. So the base case compared to some enhanced design, embedding sustainability, resilience, or other long-term impacts. And at the core of it is taking that multi-decade perspective into the future while looking at how multi-hazards affect that particular piece of infrastructure that you're looking to analyze. So in the context of how we met Richard was just as the city of Miami had issued its $400 million Resilience Go bond, so supporting the funding of critical infrastructure under the guise of fortifying and building in resilience through the issuance of public debt. That's something, as noted at the start, Richard noted the erosion of tens or over $100 billion of federal grant programs through FEMA, HUD, DOT, FAA programs that we support through economics in these merit-based grant programs that now have critical funding gaps where municipal infrastructure or the debt markets that rely on credit agencies to provide insights could be a key role going forward. And so in that particular case in Miami, we evaluated the resilience dividends, so to speak, or the value at risk reduced by changing the design and construction codes of Biscayne Bay's seawall. So what happens if you raise the height of the seawall, protecting that massive real estate portfolio and the critical assets around that from 5 feet to 7 feet, and what are the implications? And so again, taking the insights that Scott provided, the importance of looking at future hazards and climate change, and running a number of scenarios to provide that sort of downscaled approximation of the value of risk and how it's implicated by some intervention, in this case, a raised seawall, was a wonderful opportunity to meet Richard and an application of typically how we get involved. And so I would say, what I've heard here in terms of this decision framework that's supporting some of the ratings analysis, very akin to the work that we're doing supporting infrastructure design, infrastructure policies, or regulatory environment, is the importance of taking the systematic approach to evaluating these multi-hazards and critical infrastructure combinations. And it's like looking at this concept of mispriced risk. One example at Climate Week in New York, I've attended many over the years. This year was particularly focused on adaptation, it felt like, and I attended a number of insurance and capital markets events. And one of the quotes from the Aon event is insurability is bankability. And more and more as we work with insurers and we work with major asset owners, that sort of concept and dynamic, looking to fortify and build in and embed resilience, and doing so up front, bringing insurance to the table, bringing in that forward-looking set of damage functions into the design perspective, allows you to connect to the capital markets more effectively and pay for that critical infrastructure going forward.
Eric, you raised two great phrases. One I always forget, but I will continue now in the future to use resilience dividend and refer to you as the author of that phrase. But the other part, Evan, as you do your introduction and thoughts, is that this really is a systems approach. And Scott, I think one of the things that you may ask you to respond to in a minute after Evan is while we're looking at a specific asset, a specific piece of infrastructure, there's a lot of other influences, right, Eric, upstream, at point, downstream. It's the reason why we really have looked at the whole watershed rather than just this detention pond, right? But it really does require, from a community perspective as well, a systems approach. Evan, introduce yourself, give some of your thoughts.
Thanks. Well, it's a pleasure to be here. My background is as a structural engineer, so I did a lot of design work after the Loma Prieta earthquake in 1989, and so very familiar with how buildings and assets behave, particularly in earthquakes, but other hazards as well, and how to improve them to make them perform better. And so, founding the U.S. Resiliency Council, the goal of in a nutshell, the goal of the U.S. Resiliency Council is to really find ways to incentivize better performance of buildings. And what the USRC does in its rating system is try and bring a consistent and objective and quantifiable communication tool to describe how buildings perform in natural hazard events, earthquakes, wind, flood, wildfire. And the reason we apply a quantitative approach, how much less damage will the building suffer? How much less downtime will it suffer? How many fewer casualties is it likely to suffer? Okay, and the liability, costs associated with that potentially, is so that we can bring all of the players in the building market to the table to provide incentives for building owners to make wise choices. For this time, it's basically been the decision of the building owner. Do I want to design my building better? What benefits will I receive in terms of, reduced downtime, reduced liability risk, reduced costs after a natural disaster? But what we really wanted to do was bring a conversation so that the other players can offer incentives to that building owner. So it's not just on them to make that investment. And obviously, there's other players being lenders, insurers, local jurisdictions that where the buildings are, where they receive tax benefit, sales tax and property tax and all of that. Our rating systems quantify performance in a way that all of those groups can see the benefit that comes to them: lower mortgage defaults, lower insurance costs, preserved property taxes and sales taxes, and of course to the owner in business continuity and reduced damage. What we would really like to see and think that hasn't really happened yet is those incentives coming from those other players. Everybody benefits, and so everybody should participate in the additional costs that may come with making a building better or retrofitting an existing building. And so, in terms of the framework, thank you so much, Scott, for developing this. I'm sure this was an incredible amount of work with a lot of people. I'd like to sort of follow up and see sort of where the carrot side of this comes in. We sort of know where the stick is, right? We know that if a building doesn't perform well, either because of its location or because of the way it's constructed, and ratings would go down, and that will increase the cost of things like lending and insurance. How do you envision your ratings providing the carrot to lower rates or provide potential easing of capital to make better decisions about retrofitting or designing? Ultimately, that's what has to happen to adopt large-scale improvement of our infrastructure, is everyone that benefits from it, every part of the equation, part of the capital stack, if you will, and part of the operational stack. Everybody that benefits has to be willing to participate in sharing in the investment cost of resilience. So that I'll just end it there, and we'll see what kind of questions.
No, no, but Evan, you're raising a point that I think, frankly, has been at the heart of future-proofing America, trying to look at these different standards, trying to harmonize 2,600 standards with your guidance and assistance, looking at the economics, Eric, of it's gone from 1 to 6 to 1 to 11, and now, God forbid, it's gone to 1 to 33, which I personally think is crazy. But whatever that cost benefit, right? So, Scott, as in y'all's thinking about the framework being, the beginning of a journey, in your discussions, out in the public and conversations, if you had to say at the end of 2026, a year from now, what would and I'm trying to do this to protect the viability of Fitch, so you filter what I'm about ready to say and deliver. But if you and I were talking a year from now and the framework was really, really gone through a number of cycles, what do you think may happen? What cascading impacts do you think may arrive out of all of this?
Well, I think it's going to be more on folks' mind in terms of if you look at the end user here, talking to the investors that look at ratings. I think it's more topical, top of mind as they're making their decisions, and they have to they're taking on risks by nature of investing in infrastructure assets, and it's an additional piece of information that they'll have to take into account. Our only objective is to have all the information and the data to assign a rating in terms of we're not making, it's ultimately up to the investors in terms of how they'll take that information and that analysis ultimately.
I think Scott, what we talked about, oddly enough, a year ago when we were all together in New York, where y'all are today and where we kind of hope this will move. Evan and Eric, since y'all been a part of this, is I'm going to be mindful of the clock, and we're probably going to go a little bit past 11 o'clock, Scott, if that's okay, just maybe 5 minutes past at the most. But for all three of y'all, when we started looking at, and especially some of the work that Cotality, the new name of CoreLogic, and others on our data team, I define it as using kind of a Cotality statement that 12% of the nation's 90% forecasted risk exposure is already producing, Eric, about $9.5 trillion, and it's probably a low number. We kind of know where these major events are occurring, where they're persistent, where they're expected to continue. We know what the underpinning of the economic engines are of this. And so, there's a lot of variations on risk indices. I think, Scott, what y'all have begun to do, like you said, this is a journey, this is not an endpoint, is that insurance, reinsurance, mortgage, everybody has some form of looking at their risk exposure and then making a determinant of what they really are willing to spend. And so, Evan, you and I talked about this before as well. You could retrofit a lot of infrastructure, but at a certain point, the economics just don't work out. You could spend all your resources and try to prevent every kind of disaster. That's not going to happen. So I think what, Scott, y'all have begun to do with the framework is very, very important signal to the marketplace. And for these different locations, which, again, you could pick or choose, but it doesn't mean the central part of the United States is less important. You'll see different places, especially along the Mississippi River and others. But I do think, Scott, that what you all have done and the framework puts in motion is, Evan, something that says now we've got to find a way to give these stakeholders all willing to bring some incentivization, some carrot to the table. Correct? All right. So, Scott, one of the other things, and I want to just kind of wrap up a little bit of this, and I know that we're not going to cover all of it, but we've been looking at data. We now have under our resilience data exchange over 100 billion data points, and we've just recently added risk thinking AI to our team. And what we're trying to look at, Scott, is the financial, economic, fiscal with an F, and societal impacts that how pieces of infrastructure, residential, commercial, industrial, and public, at a community level, if approached the right way, both retrofit and most importantly design, you can achieve a higher value of resilience. And it's no question that there is tons of data and analytics out there. What we've decided, Scott, is that even if you rate a bridge, if you rate any piece of infrastructure, there more than likely is something that will impact and influence upstream or downstream. We saw that in the 6,700 detention retention ponds here in Greater Houston that were designed and engineered as if they were their own islands. And that's begun to change. Babcock Ranch in Florida being an example, that Chesapeake Bay, Maryland. So, Scott, again, I think the public sector and the private sector, not consistently, Evan, yet, but I do think that the folks are beginning to lean in to say, we've got the data, we know how to forecast. Now what we're looking for is actionable intelligence. The second part, Scott, that we looked at working with Gensler and others is that these are typically multiple perils and disasters. So when y'all look at, Scott, let me ask this question. When y'all look at, I think this is what you have said is there may be a predominant disaster, persistent disaster, but you all are looking at all the different disasters, because we've had areas that have gone from drought to wildfire in matters of days and weeks, right?
Yeah. So you're looking at the exposure to those perils. So looking at it on a zip code, postal code level.
Yeah.
So that's that's where I keep saying this is a screener. So that's the flag it. And then where the analysis comes in subsequently is to understand what, if any, mitigants are there to it to help us inform our analysis. And I was talking about the cash flows as well.
Right. And I think, again, some of those mitigants may not just be, and again, I think this is where this has on the steps of the journey begin to say it's not just on that bridge, but there's some other mitigants that at a larger community level can be taken, right? And then
Richard,
yeah.
if I could just jump in. So
Yeah,
just seeing the photo here and seeing the Gensler logo just reminds me of work that we did we talked about the dynamics in federal grant funding through a $130 million HUD funding to support disaster community planning going forward, and Harris County being quite as climate challenged related geography with extreme precipitation and land use planning not essentially aligning with some of the forward-looking dynamics that can implicate and exacerbate some of those hazards in the region. So HUD provided Harris with a large pool of funding to enable them to plot out forward-looking best practices in resilience against this suite of multi-hazards that you noted in your last slide. And very much as to Scott's planning process and framework, we're using economics here to denote the impact, the outcome, that resilience dividend to investing in hazard mitigation thoughtfully in a location like that facing multiple.
And let me play off, and again, I'm going to be mindful of time. I know we're running a little bit over. Scott, what we've also realized is there's over 32,000 special districts in this country. And some of them are very small and unique. Does Fitch also do ratings of these special districts? Where do those fly into?
Some of those would be under the public finance, which would be separate from the group that I'm infrastructure project finance. So those would be more municipal ratings.
Okay. And is the framework that you're rolling out?
They would have a separate. So what I've described today is the infra project finance.
Yep.
They would have a separate, which I can get to you, but that two different processes, right?
Got it. All right. And so then the last two or three things, Scott, I think that, we wanted to share, and I think are, trying to align with the three of y'all, is this shift from federal to state and local in our work with Hilltop Securities and Oppenheimer State and Local, around this opportunity to look at how do you better design the horizontal, which includes, these municipal utility districts, which obviously is on one side of the equation that you just said, Scott. But what we're also recognizing is these large-scale infrastructure projects that truly influence all the other design and land use around it. So, we've looked at the role of community resilience bonds, and we'll be making an announcement soon about a community mutual risk pool that I think your framework has and will have an impact on. But Eric and Evan, I wanted y'all to know, based on some of the work that you all have participated and sat in and discussed, is we're now very, very heavily focused on 2026 being very project pipeline oriented. Capital is not the issue. Capital is not the issue, Scott. There are more funds that have become available. We've identified in excess of about $2.8 trillion of capital that's out there. I, again, commend Fitch for taking the leadership, Scott, and you taking the leadership on, this idea that we've got to now start aligning how we're observing and rating. And Evan, to your point, we want to lean in with you and others on this call and others that will listen. We want to find champions who are willing to incentivize this new behavior. And I hate to say it, Evan, it really shouldn't be a new behavior, but I think that's where we are, is we are looking for strategic partners. We've got some already on board. We're very much leaning into no more studies, no more, hand-holding. Let's really get into the marketplace, Scott, and be able to put y'all's framework to work. So with that, Scott, any other quick last observations? I know that there's a lot more depth. We will get people your contact information if that's okay.
Sure. Yeah. Absolutely. Have my contact information, reach out with specific questions. I've tried to give it as best I can in the short amount of time, but as you alluded to, a lot of work in design and planning went into the framework. And
Right.
like I said, I think this is the starting point. A lot of this has been embedded in our analysis previously, but this is something that actually is a framework so that consistently, globally, whatever region or part of the world we're in, it's a consistent approach to looking at climate risk and the vulnerabilities that are present.
Scott, thank y'all for Fitch spending so much time with us and teaching us, and vice versa for you. Hopefully, allowing us to be able to share some of our thinking and observations. Evan, Eric, any quick last observations or comments? Evan?
Well, I would just say that as we move away from sort of federal support of resilience, putting the onus on local and state who themselves are strapped for money for things like tax rebates and tax incentives, that just takes away their revenue. We I think the global insurance, reinsurance, and lending markets have to play a crucial role. That it is not going to be something that we're going to see just put on states and locals to provide the incentivization. So that would be my comment.
Well, thank you. And thank you, Evan, for your steady hand and steady work, because I essentially have relied upon you. I know you've been at this, for such a long time, and I know you've, gotten hit and stood back up, but thank you for the work that you're doing. Eric, any last quick observation, comments?
Well, just it feels like the inevitable combination of these interdisciplinary experts in insurance, in finance, in engineering, and planning, and in economics, moving towards the end result, which is to take into account these long-term forward-looking hazards, take them back to the design, the risk, and the vulnerability assessment, and use that to inform how you approach design, how you fund, and how you engage stakeholders to get more of these types of projects designed and built to support communities.
Well, leveraging off of that and putting closure, adjournment to this, the three of y'all represent the reason why I get up and do this every day. Now, sometimes at the end of the day, I kind of feel like, we're on this treadmill, but our call to action and with the three of y'all and others who are listening in, is let's go find 3, 4, 5 projects in 2026 and finally prove this out. Let's really move this into the marketplace. Find the right champions, find the right locations. We've got some ones that are evolving in our pipeline. We welcome to collaborate and work with all of y'all. Thank you, all three. Thank you for those who are listening in. Thanks for those who will listen in later on. Happy holidays, a happy, healthy new year. Scott, thank you for your friendship and guidance and for leadership. And we will obviously be back in touch before the end of the year or right after the start of the new year. But until then, thank you all for all the work that you do.
Thank you so
Sure.
much.
Thanks for the opportunity.
All right. Bye-bye.
Cheers.
Thanks, Tom.